If you see gold at 7,000, would you not be surprised to see triple-digit silver?
Oh, $100. Yeah, it's $100, maybe $125. It's because it's easier to for portable wealth to carry silver dollars around than gold dollars.
We did have gold move higher. We had physical gold move up about 1.75%. So we got a nice move up here. We are long gold with one of our positions here. We've got a nice move in gold. Just the ETFs are the easy way to get in and out of physical gold versus buying a bar and then hawking it, for a premium. When you buy and sell physical gold, it can add up versus just a quick trade in an ETF.
There's always a buy level and there's always a short level. There's no preconceived notion. A true technician has no emotional attachment to anything. Doesn't matter. All right. If something goes high enough, we short it. If something goes low enough, we buy it. Just the nature of the beast.
The gold and silver markets are entering a new phase, driven by global debt expansion, geopolitical uncertainty, and escalating military expenditures. With inflationary pressures and sovereign risks mounting, investors are increasingly turning to hard assets as safe havens against the erosion of purchasing power. Precious metals are once again at the forefront of capital preservation strategies, particularly as central banks increasingly lean into deficit spending to fund defense and infrastructure. FrankHolmes, a respected global investor and CEO of U.S. Global Investors, shares his perspective on how gold could advance towards $7,000 within a few years, with silver potentially surging into triple digits. Alongside him, market technicians like Chris Vermeulen and macro strategists, such as Gareth Soloway, highlight how both physical metals and mining equities are showing strong signals of renewed accumulation. Each brings a unique angle, whether it's the technical setups, macro drivers, or global liquidity cycles, yet all point to a similar conclusion. Precious metals remain under-owned and undervalued in today's shifting economic environment. This cycle is particularly compelling, marked by the intersection of record-high debt-to-GDP ratios, rapid advances in artificial intelligence, and a wave of geopolitical tensions spanning from Eastern Europe to Asia. Against this backdrop, both gold and silver stand out as resilient alternatives, with miners' margins improving and capital finally flowing back into ETFs. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
If you see gold at 7,000, would you not be surprised to see triple-digit silver?
Oh, $100. Yeah, it's $100, maybe $125. Because it's easier to for portable wealth to carry silver dollars around than gold dollars. But we're seeing that wealthy families and family offices, they've been buying gold and silver and taking physical delivery.
Getting back to your new forecast of 7,000 within another 3 years from now, is there anything that could derail your forecast? What would it be?
What would it be? Short term, it may be that America says they're going to go sell their strategic pile of gold to go into Bitcoin. That's sort of a high risk for a country. I don't think that'll happen, but that would be the only thing. I think that the MM2 adoption is pretty strong with all the central bankers. The central bankers know that MMT, basically modern monetary theory, is a precursor for currency devaluation, and you should have hard assets. If there are war breakouts, then your paper money falls dramatically, but gold holds its value. And with the stress that's taking place in Eastern Europe, the stress that's in Africa and in Latin America, I see that the hoarding of gold and silver will continue. Well, I think that when we look at, and which you've had many people speak so eloquently about BRICS and the assault on America to de-dollarize the U.S. dollar, what's really happened for me is to see one road, one belt. It's really by China, one belt of communism. And it's about removing democracies. It's about sponsoring dictators like Maduro. And there's over 100 countries. China now controls 100 ports. There's this whole agenda to assault the U.S. or democracy infrastructure. And people are not really aware of that. in the general mainstream. And I think that what we're witnessing is AI. AI is booming. It's a game changer. So the U.S. has been spending a lot of money on AI for the military, and we're seeing cybersecurity attacks all through Europe. We're seeing Putin not only invade Ukraine a second time, now he's using drones to go in and lock down airports in Poland, in Denmark. They sabotaged a GPS system for President of the EU trying to land her airplane in Bulgaria. It took a long process for the safety. Now we find out that car manufacturers in the UK have been shut down for a month. Heathrow Airport was shut down for a weekend, all with cyber attacks. So we're witnessing a huge deficit spending. Unlike before, it was just a social contract for social welfare. It's about national defense and the operative word sovereign. We're seeing, I know from my data center business in Canada, I just came back from Montreal where they had the big all-in event, and everything is about sovereign data centers. The same thing when you go to Finland and Sweden and Norway, sovereign data centers to protect the data. This protectionism is growing everywhere. So the idea of open borders is done a 180, and it's big walls. We're seeing it in Poland with Belarus. I thought it was Belarus from trying to leave and Ukraine to go through into Poland. No, it was basically what's been militarized and has been humans, particularly from poor Muslim countries, that Putin takes them up into Belarus to try to come in to invade into Poland. And what they do is they overwhelm the education, the social welfare, the healthcare, and the security. And that has been happening in Italy, from North Africa. There were many North Africans that were flown over to Mexico to come across into Texas, into the border. So now we're seeing huge G20 deficit spending. And when you look at that data point, since COVID, it's up $75 trillion. It's not just America. It is the G20 that the global debt is $325 trillion, and it's growing at 9%. But the bulk of it now is for military spending. So we're at the intersection of military spending for defense, along with this money printing makes alternative asset classes like gold and silver and palladium very important. And we're seeing another level what China's trying to do, not only with strategic minerals to cut them off, they are trying to become the kingmakers of gold. The market, they want to mark the basically today, they dictate the price of gold like lithium prices. That is the direction. And so this deficit spending is going to now be military defense. I think the younger retail investor that uses social media, they'll probably have better information by the time it makes from this program and yours and your huge, massive following, etc. That's what they're going to learn, that narrative of how these dynamics are unfolding. And so I think that those demographics do show up. And then you have this really clever, smart people that are over 70 years old that want to stay active and working. They're the ones that are following your program. But the ones in the middle that really don't grasp it, that's what I'm finding most interesting. Otherwise, it's going to be generations X, Y, and Z. And it's not war for aggression, but it's basically defense against the five evils. North Korea has soldiers fighting for Putin in Ukraine. You have Putin. Then you have the leader of Iran. You have Xi Jinping has become a huge military spend, massive military spending. And we are seeing a huge military infrastructure being built up along the border of China and Tibet. Along that part of the world, a super highway, military airports being built all along to go basically towards India, and everyone's focused on Taiwan. I think that we could see a friction between India and China. So they're all spending. They're all using deficit spending money, and that element that it doesn't matter if it's fear trade or love trade. It's just so important that when the debt is 230% of the GDP of the world, if the total debt is 230% and people are becoming fearful of the predatory practices of about 5 groups of people, then we're going to see currencies going down in value more rapidly than before, and alternative asset classes like gold and silver become more valuable. It's just simple. And Ray Dalio's done a great job of having 10% weighting. But I share with the gold stocks, their margins have really expanded this cycle. And last hours of your program and following the 80, almost 90 gold producers around the world, I mentioned that I track who has free cash flow every quarter, year over year, and quarter over quarter. Well, it's growing rapidly, and they're now showing up in IBD, which is a growth stock picking publication, and gold stocks
Yep.
are changing those dynamics. But did you know for most of this year, GDX and GDXJ had net redemptions? People not believing that. Just recently, this summer, have all of a sudden money flows gone into the gold equity ETFs. So there is something that is significant that I believe we're early innings for a gold trading much higher, and the gold stocks having, besides 100% gains, we're going to see, like we've seen before, 200, 300, 400% gains.
Gold continues to show strength, advancing another 1.75% in recent sessions, with technical indicators pointing toward higher levels ahead. The current move is targeting the 3071 zone, representing a measured breakout pattern that still carries room to run. ETFs such as GLD and GLTR are proving popular as they allow investors to access physical metals without the friction of premiums or storage, while also offering exposure to baskets that include gold, silver, platinum, and palladium. Momentum across precious metals remains strong, although conditions now resemble a feeding frenzy phase often seen near the latter stages of a rally. Gold miners, as reflected in GDX and SILJ, have surged parabolically, raising the risks of sharp pullbacks once enthusiasm peaks. Silver's trajectory toward the historically significant $48 to $50 zone illustrates both opportunity and caution, as such levels have repeatedly acted as ceilings in past cycles. At the same time, broader market dynamics suggest a potential stock market top similar to 2007, where gold accelerated even as equities collapsed. This parallel highlights the importance of careful timing, as what begins as a short-term trade may evolve into a long-term allocation if broader financial resets unfold. Let's get back to the interview.
We did have gold move higher. We had physical gold move up about 1.75%. So we got a nice move up here. We are long gold with one of our positions here. We've got a nice move in gold. We still have the next target still substantially higher, around 30.71 from this move. So we've continued to ride this. We've already locked in gains at our first target here at the golden ratio. And now it's working its way up to the 100% measured move. It's about 8.5% upside move in gold. This is the Sprott Money Gold, but it's the same if you look at GLD, it's another physical gold fund, or if we just look at gold futures themselves, it's the same move no matter what that needs to unfold. Just the ETFs are the easy way to get in and out of physical gold versus buying a bar and then hawking it, for a premium. When you buy and sell physical gold, it can add up versus just a quick trade in an ETF. Or if precious metals continue to push up and you don't have a big enough position, you want more, greed will get into in there and want to get you back into the market. Or if you're not in the precious metal space or not in the uranium space, you get this massive FOMO. It can create some pretty bad trades. And as we've seen, if we look at GDX, I still think there's room to run in this market, but just look at GDX. Look at the parabolic price move that's happening. We go back in time, it has just exploded higher at the large caps. And if we look at the SILJ monthly chart, again, this is what happens usually. It becomes a feeding frenzy, and it can last several months. But usually what happens after a feeding frenzy in the perfect storm scenario, which we are in right now, we tend to see eventually, people tend to buy near the high. That's where the majority of people pile in. And then we start to see a big collapse in price. And people who thought it was going to the moon realize it was really they were chasing price and they bought it at nosebleed territory. So that's what we just need to be aware. Is it a trade? Is it a gamble? At this point, jumping in, if you're not long the markets already, the precious metal space, it is definitely carrying a lot more risk. There is room for the upside, potentially a couple more weeks, 4 to 6 weeks, maybe. And in that time window, we could actually see the stock market top out, which we covered in pretty good detail when we look at the 2007 peak, which I need to go back to. This is typically what happens just before the stock market puts in a massive top, like in 2007 where it fell 55%. We see gold take off, and then we see platinum, palladium, gold miners, silver. They all kind of break free and start to expand higher and shoot up here. And then the stock market starts to correct. And of course, we have a very similar scenario. Stock market at all-time highs, gold breaking free. We have miners starting to explode and become the crowded play. The dollar is worthless. Everybody hates the dollar. And so that is the scenario. We're potentially somewhere close to the first big pullback in the stock market again that will turn into a 55% potential correction or even bigger maybe. So we just need to be aware of that. And just keep in mind when the stock market tops, gold, silver, and miners can keep moving higher as the stock market goes down temporarily, but eventually we see a big pullback. Platinum, silver, miners, they all pulled back about 65+% during that correction. So they are a trade at this point, and eventually will become a long-term investment if we get that big financial reset. Then you can park it for a long-term gain after that. But again, to me, this is just a trade moving up. That's why we've taken an extra discretionary trade in gold, or however you wanted to play this. I know a lot of you did leverage. I know a lot of you have done miners. But this is a trade. We're looking for this final push and pop in price just before the stock market potentially has a much bigger correction. I mentioned this ETF, I think it was Friday, GLTR. This is a precious metals basket. So if you actually wanted to dip your toe into the water, this gives you gold, silver, platinum, and palladium in one trade. So it's heavy weighted in gold, which I like because it takes some of the volatility out. But it does give you a basket and potentially could see this run higher. But you can definitely see it's at a very nice run, breaking out of a big base and moving up. So there's a way to play kind of a basket of those plays.
Gold today is up on a weaker dollar and the momentum continues. Now, what I'm following here is we have this beautiful parallel. We tagged it right here. We pulled back. Now we're piercing it today. Now the question is, as we pierce it, you can see it's already pulling back a little right there, but let's watch to see, does it stay above? Does it close on? Does it close below the line? Where does it go here? And ultimately, that is something that we have to monitor. Okay, so again, watching very closely, does gold behave like gold should, or is gold in a world of its own where it's just going to keep rallying and rallying and rallying? If it gets through here, folks, I don't think there's any stopping it until at least it pierces 4,000 in the near term. But this is still a level I have to monitor because, again, history has shown us that it has been resistance as well as major support inside of this parallel. Now, silver is just a rock star. All right. Now, I did say that it would pause at 44, which it did 2 days, and then it would rip higher to 48 to 50. It is getting very close. Now you can see, where do I get my $48 to $50 target from? Well, basically the high in 1980 was 48. The high in 2011 was 50. So we're just using a simple zone of where it stalled out the last few times. That's where I'm looking for this to go. Now, people have been asking me, would I consider shorting silver? And the answer is yes. There's always a swing trade short, right? And again, the key is, there's always a buy level and there's always a short level. There's no preconceived notion. A true technician has no emotional attachment to anything. Doesn't matter. All right. If something goes high enough, we short it. If something goes low enough, we buy it. Just the nature of the beast. And so with that, as much as I've liked silver and it's been breaking out and it's been going towards that upside target, the question then becomes, well, where would I do a swing trade short? And please understand, folks, I'm not saying where do I think it's going to collapse and go to zero. No, it's not doing that, right? So again, the bulls out there will get all in a hissy fit and, oh my goodness, all that nonsense. That's irrelevant. Remember, I'm short term. So I basically am looking for where can I get 5 or 10% on a pullback on silver? And the answer is very simple. What you would do here, and this is where I'll tell you right now, this is where I'm going to take a trade. You take your high from 1980, you connect it to your high from 2011, and it's a slightly ascending trend line, and that becomes my entry price. And essentially what we can see is there's a beautiful trend line there, and this would actually be right around $50.90, $50.85. If we go straight up there, I would expect we hit that line and we pull back 5 to 10%. I'd grab my money within a few days and say thank you very much. If we go back to gold, I'll show it to you right here. Look at this. Let's zoom in right in here. Let me bear with me as we bring this in, right? So essentially, gold had this move up and then literally from 2023 right here to 2024, it went sideways, bull flagging, and then it broke out, right? So, I mean, very similar price action versus the UGA. And so just keep that in your back pocket. Keep that in mind that oil may be setting up for a major breakout. Now, it's not going to be because the US economy overall is strong. We clearly see it's not. But again, the energy demand from AI is massive, and more data centers from other countries will be coming online over the next couple years, and there's going to be a massive power drain on the grid, essentially, and that's going to force prices up for you guys, for me, for everyone else. We're going to be paying for these data centers, essentially, via energy costs. Really crazy stuff.
Gold and silver are no longer defensive assets. They have become a strategic cornerstone in the face of growing market fragility. As central banks continue to accumulate reserves and debt markets signal long-term stress, the precious metals space is entering a cycle that may define the next decade of wealth preservation. The opportunity now lies not just in the metals themselves, but in understanding where we are in the broader rotation of capital. History has shown that when confidence in paper assets begins to erode, hard assets respond with robust and sustained moves. For investors willing to position ahead of the mainstream, the current moment offers rare asymmetry. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.